In January 2000, millions of football fans watched a sock puppet holding a microphone interview people on the street. That single puppet cost a company called Pets.com over $1 million for 30 seconds of airtime. A few months later, an online grocer named Webvan was buying fleets of delivery trucks and building massive warehouses. They burned through $1 billion in cash without generating a single cent in profit, entirely convinced that reckless growth was the only way to win the internet. This era birthed an unofficial economic theory on Wall Street, the Super Bowl test. The premise is straightforward. When speculative tech companies flush with cash start buying up the most expensive advertising real estate on television, the market is typically at its peak and a collapse is imminent. 2 decades later, we can run that exact same test. During the latest Super Bowl broadcasts, artificial intelligence companies bought up nearly a quarter of the available commercial inventory, spending millions per slot to promote technologies that are barely understood by the public. This chart shows the total market capitalization of the S&P 500. A massive portion of this value is heavily concentrated in just 7 technology companies. These firms now dwarf the other 493 entities on the list, making up roughly 40% of the entire index. If we isolate the market's growth since 2023, the concentration is even more extreme. Between 75 and 85% of all total stock market gains in that period have been driven strictly by enthusiasm for artificial intelligence. The primary beneficiary of this spending is NVIDIA, led by Jensen Huang. They produce the hardware required to make AI function. In a market obsessed with computing power, these semiconductors are the oil of the 21st century. Trillions of dollars are currently pouring into this sector. We are either watching the construction of a permanent, hyper-efficient digital economy, or investors are blinding themselves to history and walking into a repeat of the 1999 crash. To test that thesis, we need to look at the late 1990s. While everyone else was trying to build websites, Cisco Systems focused on the plumbing. They manufactured the physical routers and switches that connected desktop computers to the early internet. This line graph maps Cisco's stock price over a 5-year period. As the World Wide Web rapidly expanded, the demand for networking equipment exploded. Between 1995 and early 2000, Cisco's stock grew by an astonishing 3,800%. By March of 2000, the company hit a market capitalization of nearly $557 billion, making it the most valuable company on the planet. Then, the speculative capital evaporated. The hype faded, and Cisco's stock plummeted 88. The irony is that the original tech thesis was completely correct. The internet did rewire global commerce. Consumers kept buying routers, and Cisco's actual sales more than doubled over the following decade. But the company's operational realities could not support the frantic expectations priced into the stock. Because investors had paid a massive premium for future hype, it took 2 full decades for Cisco shares to return to their year 2000 levels. A technology can succeed flawlessly in the real world while simultaneously ruining the people who invested in it. An undeniable technological transformation is not a defense against paying too much for a stock. Today, NVIDIA's CEO Jensen Huang argues that artificial intelligence will surpass the PC, the mobile phone, and the internet combined. We can see this chart mapping the architecture of these 2 eras side by side. On the bottom infrastructure layer, Cisco's role as the physical router provider in the year 2000 mirrors NVIDIA's role as the physical chip provider today. Moving up to the middle layer, the early internet relied on telecom companies and web browsers to function as enablers. Today, that identical space is occupied by hyperscalers and large language models. Finally, the top application layer sits over everything. Where early consumers used Yahoo and Amazon, modern consumers are engaging with thousands of newly funded AI-native applications. But there is a distinct difference in the ledgers. While many dot-com startups operated on negative gross margins and fictitious business models, today's AI hardware leaders are generating massive, sustainable cash flows. The premiums being paid for these companies are certainly high, but they are currently grounded in actual near-term earnings from major corporate clients. The underlying financials of the AI boom are provably stronger than those of the late 90s. Yet the tech sector is repeating an identical pattern of aggressive infrastructure hoarding, a dynamic that carries severe systemic risk for anyone buying in right now. Investor Peter Thiel has famously argued that competition is for losers. In his view, lasting value is only created by building a complete monopoly that makes alternatives irrelevant. Artificial intelligence is uniquely positioned for this kind of dominance. It relies on data network effects. Every user interaction trains the model, meaning the system inherently grows smarter and more capable simply by having more people use it. This creates a brutal winner-takes-all dynamic. Tech giants are trapped in a panicked arms race, forced to spend billions of dollars hoarding semiconductors just to build an insurmountable computational advantage over their rivals. History reveals a flaw in this strategy. Look closely at previous technological booms, and you will find that the first movers who burn their capital constructing the initial infrastructure are rarely the companies that survive to control the mature market. The multi-trillion-dollar spending on chips represents a defensive financial war for corporate survival. This creates an environment where market valuations are driven by fear of being left behind rather than actual consumer demand. Foundational technologies follow a strict historical timeline. Whether it is laying physical track or running thousands of miles of fiber optics, massive infrastructure buildouts consistently take much longer to deploy than impatient investors assume. When the dot-com era imploded, miles of dark fiber optic cables were left buried underground. Today, we are constructing massive AI server clusters across the globe, pouring raw capital into physical hardware. Eventually, this triggers a consolidation phase. The public hype severely outpaces the actual technological rollout. The speculative capital vanishes, the vulnerable valuations collapse, and the overbuilt hardware infrastructure is quietly liquidated for pennies on the dollar. But this is precisely when the most significant wealth creation occurs. The companies that emerge from the crash don't have to spend billions on servers. They simply build highly profitable applications on top of the cheap, discounted infrastructure left behind. The true victors of the semiconductor war will likely not be the people purchasing hardware stocks at their absolute peak. The winners will be the investors with the discipline to wait, observe the market, and capitalize on the wreckage when the technology finally matures.